Good morning and welcome to another weekend update for January 30th. We've been looking for a correction now for a couple of weeks. It's the middle of January, and certainly we've got the final piece of the puzzle falling into place on Friday night with the US market falling over, and it'll be interesting to see how it plays out in the next couple of days. But let's have a look at some of the charts to make sure that we're positioned as best we can. So first of all, it's the important information and licensing information. So just a bit of a quick summary of where we're at the moment. From my perspective, the start of the correction is now confirmed. The one thing that we don't know is whether it's going to be just a very brief blip down of perhaps only a few days, or whether we're going to get something that's going to play out over, perhaps 4 to 6 weeks. So the US indices, the S&P and the Dow Jones and the Nasdaq were the last to roll over. Finally, been waiting for it for a couple of weeks, and there was a fairly significant move down on Friday night. As I wrote in the alerts, if you really look at the economic numbers that were supposedly the excuse for why the market fell as much as it did, which is about 1.7%, the numbers really I thought were pretty reasonable. So I think it was really the market was just basically due for a correction, and that was the trigger. And once the cascade started, then it basically just continued through into the close. The Shanghai index, the Shanghai Composite, is holding support at the 2650 to 2700 area, and really needs to close above the 2760 mark to indicate that they can go to higher levels there. Now I just want to have a look at some index targets. These are only where I believe the probabilities are, and they're not really a firm forecast in any way, but it just gives us a little bit of a framework to work against, just to see what would be normal under most circumstances. So these are assuming just a normal mild correction, which is consistent with the size of the rise we've had, which has been fairly substantial. And I'm really not seeing any circumstances that would suggest this will be anything other than just a normal mild correction that markets have to go through before they can further advance. Now the S&P perhaps down around about the 1220 mark, down around about 6% on its peak. The ASX 200 perhaps down around the 4500 mark, and the Small Ordinaries Index in Australia down perhaps 10% from the peak, or about another 5 or 6% from where it is now, down at 2670. Now having said that, indexes, when you look at the percentage movements in the index, there are obviously many stocks that can move far more than that. So it's quite possible that you could see stock price falls on an individual basis of 10, 20, perhaps even 30%. So don't feel that you're only going to have that kind of reduction across the value of your portfolio. It could be greater in certain stocks. So let's have a look at the charts. So the first one is the US dollar index, and as I wrote in the alerts, what I found really interesting about Friday night is that the US dollar did kick up, which is pretty normal. The stock market starts to decline. People want to put their money into some of the safer avenues, or perceived safer avenues, such as bonds or the US dollar. So the US dollar did kick up, but so did commodities. So that was a dynamic you don't tend to see too often. So next we'll have a look at the S&P 500 chart. So you can see Friday night, just tightening on that. Friday night, this was the most significant fall that we've had. You've really got to come back here to the 11th of August 2010 to see a fall of that sort of magnitude. You can see the last time that the S&P was this overbought, we did get a correction that lasted from the 7th of November and really finished on the 30th of November. So it lasted around about 3 weeks. It was pretty mild, only pulled back about 50 points on the S&P, and then it was off again. We've now been overbought for quite some time, since basically the early part of January, and so finally the market has rolled over. So if it plays out in a similar kind of fashion to what we've seen before, there's a couple of signposts we can look for. The first one is this uptrending channel which the S&P 500 index has stayed within since back in August, when Ben Bernanke made his famous speech about printing money. So to me, I would expect this uptrending channel will break, because we really need a correction of this move from August to the current time to really set the market up for further advances. So to me, I think it's likely that we will perhaps pull back a greater amount than we have seen here in the November period. So the first retracement level on the big picture move is around about the 1200 mark. We've got the retracement of this smaller move from the 29th of November, and the third retracement level on that is at 1221. We've also got this old peak here going back into last year at the 1220 mark. So I'm really looking at somewhere around this 1200 to 1220 area as being a target, and that'll then give us a normal kind of retracement, 1/3 of this major gain, and then that opens up the market for further advances into the middle of the year. So I think that's the most likely outcome, but it's likely to do it in a fashion something like the following, because again, that's how human psychology works. We get this initial substantial drop. Wouldn't be at all surprised to see a little bit of a bounce on Monday night, and that's why we just need to be a little bit careful if we're going to take some short positions, and I believe we now should be starting to take some short positions in the expectation of getting a bit of downside for a few weeks. So we just need to be a little bit careful about how we get into those short positions on Monday, if at all. So certainly don't short sell on a gap down on Monday morning, because you'll probably find that the market will open down and then trade upwards. I think that's what you'll see with most stocks. So certainly you don't want to be trying to short sell into the opening price. Next, we'll have a look at the ASX 200, and we're also in an uptrend channel, not with as much momentum as the US market, and we're sitting currently just a little under mid-range. Now the futures are indicating that our market will open up down around about this 47.20 area at the moment, perhaps even a little bit lower. So it'll be very interesting to see what our market does, whether it maintains this uptrending channel. I think if the US is going to fall to the degree that I've indicated, then that's why I'd be looking back down here, somewhere around about the 4,500 mark, which corresponds to basically the midpoint of this run up here from July. So the bottom of our market was 6th of July. 50% retracement of what we've seen before would bring us back to the 4,500 area. So I think that's the most logical place. As you can see on the RSI, our market hasn't got nearly as overbought as the American market did. So really looking for our market to pull back to that sort of level. Let's have a look at the XSO and what it's likely to do. I think, again, I'm looking for perhaps a pullback to the first retracement level of this whole move from early July, which brings us back to this 2667 area. Also corresponds with the support level, basically support level through here, picking up those bottoms through there, and perhaps by the time we get there, this 150-day moving average would be up closer to that level. So we've really got three factors offering support around that level. Now again, we're not going to go straight